Hello everyone, this is Gracie here. In this video, we will be discussing about International Financial Reporting Standard 14, Regulatory Deferral Accounts. So before explaining what is regulatory deferral accounts, let us know what is deferral accounts. So deferral accounts for expenses that have been prepaid or early receipt of revenues. Deferrals allow the expenses or revenue to be later reflected on the financial statements in the same time period the product or service was delivered. So, what does it mean is your prepaid expenses or prepaid incomes. So, where you you do prepayment in order to avoid the monthly payment and avoid penalties for delaying in the payment and delaying in such payments. So what is the meaning of deferral and accrual is some of the major difference between accrual and deferral accounting include deferral accounting includes payment documentation where it is information about the payment done, whereas accrual accounting includes a company's expenses that's occurred but it's not yet reported in the financial statement. Accrual where it is expenses occurred but the receipt for it or the payment of money for it is not yet done. Where deferral pertains to a payment made in one accounting period but it's not reported until the next accounting period. So what is deferral is the prepayment of any expenses or receiving of any expenses or revenues for which is already accounted, and later it is also reflecting in the financial statement. So what is the error of this deferral expenses is a deferral often refers to the amount that was paid or received, but the amount cannot be reported on the current income statement since it will be an expense or revenue of future accounting period. So, what is deferral error here? What is the error occurred in this deferral accounts is the amount that was paid or received, but the amount cannot be reported on current income statement. So that income, for example, April month's payment to be included in the current month itself, and May's should be included in the month of May. So where when it comes to deferral error, they include May's as well. April months in a current period might be April, where they include April as well as May's which is prepaid as it is received, or any payment which is already made for the 2 months beforehand itself, or forbearance before itself. Then both the month's amount will be accounted in the current month's transactions or current month's financial statements. So that is a deferral error. So what it tells is that month's income to be recorded in that current income statement. So deferral error often refers to an amount that was paid or received but the amount cannot be reported on current income statement since it will be an expense or revenue of future accounting period. Yes, you make any payment for April, it should be accounted in April. Any payment which is made in the month of May should be accounted in the May. Any prepaid expenses to be noted that expenses will be a revenue, or any expenses should be accounted only once but shouldn't be shown in later cases or latter cases in the financial statement. So that is why IFRS 14 states regulatory deferral accounts. So all prepaid expenses or revenues which is met should be accounted in the financial statement or regulated, or should be regulated and then accounted. Should make sure that the such recording shouldn't be in the financial statement, upcoming financial statement, or it shouldn't be carried forward. That is what IFRS 14 regulatory deferral accounts explains here. So IFRS 14 is designed as a limited scope standard to provide an interim short-term solution for rate regulated entities that have not yet adopted IFRS. Its purpose is to allow rate-regulated entities adopting IFRS for the first time to avoid changes in accounting policies in respect of regulatory deferral accounts. In order to avoid all these confusion in deferral payments, deferral transactions, for example, expenses for which is already paid or all the expenses are being met for the products or services which was being delivered or yet to be delivered. So such transactions shouldn't be recorded in all the in the or shouldn't be carried forward in all the other financial statement, or shouldn't be recorded in the other financial statements. In order to avoid all such deferral accounts, this IFRS standard is set up to properly regulate and account such deferral transactions. So what does this IFRS 14 explains here is, or the objectives of this IFRS 14 is that it is established to specify the financial reporting requirements for regulatory deferral account balances. So it is only established to know what is required in the financial statement, and and only such requirements for regulatory for account balances that arise when an entity provides goods or services to customers at a price or rate that is subject to rate regulations. So based on the payment what is being received, that particular payments or any deferral account balances only to be recorded in that particular period. So what is the scope of it is, IFRS 14 is permitted but not required to be applied where an entity conducts rate regulated activities and has recognized amounts in its previous financial statement that met the definition of regulated deferral account balances. So it is IFRS 14, so deferral transactions is permitted but only once, that is, it can be used or it can be recorded unless and until it is not recognized in your previous financial statements. Yes, once recorded in that previous financial statement, should the recording of it again and again should be avoided. So rate regulations will be applied. When applied, the requirement of IFRS 14 must be applied to all regulated deferral account balances arising from an entity's rate regulated activities. So next point, what IFRS 14 discusses it, presentation in the financial statement. So the impact of regulated deferred account balances are separately presented in an entity's financial statement. Yes, the information about these regulatory deferral transactions are separately presented. So how is it being presented is, a separate line items are presented in the statement of financial position for the total of all regulatory deferral account debit balances and all regulatory deferral account credit balances. Yes, a separate line of items should be presented in the statement of financial position for all deferral debit balances as well as credit balances. Regulatory deferral account balances are not classified between current and non-current but are separately disclosed using subtotals. Yes, it doesn't come under the line of current or non-current. It has a separate heading called as deferral payments, deferral receipts and payments. Under that, as a subtotal, it will appear in the financial statement. The net movement in regulated deferral account balances are separately presented in the statement of profit and loss and other comprehensive income using subtotals. Yes. So what is IFRS 14 trying to conclude is that any deferral payment should be regulated or should be checked that it that once appeared in the previous financial statement shouldn't be recorded in the future financial statement as well. It should be regulated well, so such payment shouldn't be repeated again and again, and the presentation of such deferral payments or deferral accounts should be presented in a separate line in the financial statement. IFRS 15 Revenue from Contract with Customers. So here IFRS 15 is an international financial reporting standard which was established or which was introduced by the International Accounting Standard Board, providing guidance on accounting for revenue contracts with customers. So it was established to provide a guidance for accounting all the revenue which is recognized from a contract with customers. So it was adopted in 2014 and it became effective in January 2018. So what is the purpose of IFRS 15, or what is the objective for which IFRS 15 was established is that the principles that an entity shall apply to report useful information to users of financial statement about the nature, amount, timing and uncertainty of revenue and cash flows arising from contract with the customers. So what is the main objective of IFRS 15 is it was established to disclose all the information to the users in the financial statement about the nature of the contract, what is the amount or what is the revenue to be recognized from that contract, at what timing it is being recognized, is the revenue certain or uncertainty, whether you will recognize that revenue or you will not. That is known as uncertainty of revenue and cash flows arising from contract with the customers. So we have already discussed related party disclosures about a related transaction in your previous IFRS standards. What is the difference between that standard and this IFRS 15 is where in this standard, or which it was mainly set up, IFRS 15 is mainly set up for revenue from contracts with customers, that to provide one comprehensive revenue recognition model for all contracts. Earlier, there are different contracts. So it was only disclosing information about different contracts, like you had insurance contract, consolidated financial statement, business combination, where parent and subsidiaries. So there are different contracts where each IFRS standard started explaining it. But this IFRS 15 explains that whatever revenue you recognize from all the contracts of that particular entry, should be recognized or should be shown in the financial statement or to be accounted in the financial statement as one comprehensive revenue model for all the contracts with customer to improve. Why is it? It is to improve comparability within industries and across industries. So how will you revenue recognize? How is the revenue recognized under IFRS 15? That is, how will you generate income from, how is the income generated or how is the income being accounted in the financial statement from which is received from the contract? That is known as recognition of revenue under IFRS 15. How is it recognized is an entity applies the following 5 steps. So it applies following 5 steps to identify the contract with customers. So it adopts 5 steps to identify the contract with customers. So what are the 5 steps is step 1, identify the contract with the customer. Yes, so to recognize a revenue, these 5 steps should be followed. The first step is you identify the contract with the customer. So who is your customer with whom you're going to get into a contract? The second step is identify the performance obligation. Identify the performance obligation in the contract. Performance obligations are promises in a contract to transfer to a customer goods or services that are distinct. So here you will identify the performance obligation in the contract for what you have entered contract, Are you subjected to transfer of goods or services for what is the contract being formed? First, you identify the contract with the customer, identify the performance obligation in the contract, determine the transaction price. So, transaction price is nothing but the exchange for the goods and services what you have rendered. The value for which you are exchanging goods and services should be decided. Next, allocate the transaction price to the performance obligations in the contract. So you're going to allocate the transaction price. So you're going to fix the rate for the service or for the goods what you have rendered in the contract price. Then you recognize revenue as the entity satisfies a performance obligation. Yes. So as soon as the performance is delivered, that is, you have satisfied the customer with your performance, the revenue will be recognized. So application of this guidance will depend on the facts and circumstances present in a contract with the customer and will require the excess of judgment. So any revenue which is recognized from a contract will be shown in the financial statement when it is recognized as soon as the performance is done. The money when you receive for that task will be recorded in the financial statement when it is being revenue. So that is what revenue recognition from the contract, in the sense when the revenue will be recognized is the revenue can be recognized based on credit basis also. For example, you render services now and for money for it will be delivered in the future, or you prepayment will be done and the services can be rendered in future. So what is the accounting policy here? When the cash is received, that means the revenue is recognized. So you recognize revenue at that time when the transaction is being occurred. So as it can be later or it can be earlier. So it is based on the contractors. So here, recognize revenue when or each performance obligation is satisfied. So the revenue can be recognized even prior to the performance obligation, or the revenue also can be recognized after the performance is being rendered. So how will you account in the financial statement is when the transaction is already done, then when any cash is received for that performance, you need to record that in your financial statements and show it in your financial statement. So how is revenue recognized is when, according to the principle, revenues are recognized when they are realized or realizable and are earned. Usually when goods are transferred or services are rendered, no matter when cash is received. In cash accounting, in contrast, revenues are recognized when cash is received, no matter when goods or services are sold. Yes, it's right. Where when cash is received, that means the revenue is recognized. Whether the goods are sold or whether the goods are yet to be sold doesn't matter. As soon as the cash is received, the revenue will be recognized and it will be showed in the financial statement. So there's no accrual basis or deferral basis here. Only when it is like when the cash is received, it has been accounted. Then you have the next topic here, presentation in financial statement. So how are you going to present it in your financial statement? Presentation in financial statement. Contract with customers will be presented in an entity statement of financial position as a contract liability, a contract asset, or receivable, depending on the relationship between the entity's performance and the customer's payment. Yes, what this paragraph explains here is the contract with the customers. When will the information regarding the revenue which is generated from the contract with the customers will be presented in the financial statement is based on the contract liability position of the contract liability, contract receivable, depending on the relationship between the entity's performance with the customer's payment. It means as it is mentioned between in the agreement between the contract with the customers. Based on the payment procedure or contract liability, contract receivable and receivable terms which is mentioned in the contract agreement, based on such customers' payments and entities' performance as per the agreement statement, as per that what is the terms which has been satisfied in that agreement. Based on such conditions, the presentation in the financial statement will be presented. That is, the revenue will be presented in the financial statement. So a contract liability is presented in the statement of financial position, where a customer has paid an amount of consideration prior to the entity performing by transferring the related goods or services to the customer. So a contract liability is presented in the statement of financial position. So any transaction under this IFRS 15 to be recognized for the contract, or any revenue to be recognized in the contract, will be presented in the financial statement only when a customer has only when the payment or the receivable is done. So when any transaction is being transferred and the amount is received for that particular transaction, only then such figures will be shown in the financial statement. So where the entity has performed by transferring goods or services to the customer and the customer has not yet paid the related consideration, a contract asset or a receivable is presented in the statement of financial position, depending on the nature of the entity's right to consideration. A contract asset is recognized when the entity's right to consideration is conditional on something other than the passage of time, or example, future performance of the entity. The receivable is recognized when the entity's right to consideration is unconditional except for the passage of time. So apart from the receivable, that is, revenue is recognized only when the amount is being received for such goods and services. Only such figures will be presented in the financial statement, or else based on future obligations. So any future obligations which will be already mentioned in the agreement when the partners are getting into the contract, based on such future obligations also the amount will be considered, or the payment or the receivables for that particular goods or services, or for any activities engaged between the contractor and the entity. Based on future obligations, it will be presented. So what is presentation financial statement, I would try to conclude here is, so any receivables which is done, might be any payments or receivables is received, will be presented in the financial statement. Only then the revenue will be recognized for rendering or for satisfying such performance obligations. So any receivable or payment is made, only such figures will be shown in the financial statement from the contract, or which will be shown as revenue recognition from the contract. If there is no payment and only a performance obligation is done, that is, only rendering services or rendering goods is being transferred from the contractor to the customers, and no related transactions are presented, then such obligations will have conditions where whether any future obligations or future relationship between the entity and the customers are to be satisfied. If there's any future discussion or future obligation or future adjustment for that transactions is being made by the customer or by the entity in the contract, then based on such obligations, the amount can be recorded in the financial statement. Thank you everyone.